Hey everyone, welcome back to Corporate Decoder, the place where we sift through corporate filings so you don't have to. Today we're diving into Aspira Women's Health's latest proxy statement, and trust me, it's a wild ride. Buckle up because this one has it all. Board shakeups, reverse stock splits, and a whole lot of executive compensation drama. It's like a corporate soap opera, and we've got front row seats. The big picture: Aspira is asking shareholders to approve some major changes, including a reverse stock split, to try and keep their Nasdaq listing and a new compensation plan. Let's get into the details, shall we? First up, they're holding their annual meeting in May of 2025. They have 6 proposals for the shareholders to vote on, most of them revolving around company reorganization and Nasdaq rule compliance. The first proposal is about electing 5 directors. It seems pretty standard, but what's interesting is who is getting elected and who is leaving. There have been some big changes in the boardroom. Several directors have resigned. Now they're nominating 5 new directors, and not all previous directors will be running for election. When this happens, it's always worth asking why. The board has determined that all current directors are independent, meaning they don't have a personal stake in company management. Let's talk about how the board is getting compensated. Previously, the directors received a mix of cash and stock awards, but that has changed. They are adjusting the equity retainer for directors and making it exclusively in restricted stock units, or RSUs. What is an RSU? It's essentially a promise of stock down the line, almost like an IOU. The chairperson of the board now gets $115,000 in restricted stock units and $40,000 in cash. Other outside directors get $70,000 in RSUs and $40,000 in cash. Here is a quick look at how much the board made in fees in 2024. Keep in mind these figures are just for the year 2024. Some directors made around 60-80k total. A board is getting paid a lot of money as the company makes its own plans, so this could be a significant expense, especially if they aren't performing that well. Now, let's dig into the executive compensation, also known as the big bucks. We need to pay attention to this table to see if the executives are being paid a lot more than the company is bringing in revenue. In 2024, there was a bit of a shake-up of executives, so the story of the year is seeing who made what and why. Here are the big figures. Nicole Sanford, who was the former president and CEO, got around 400, and CEO got around 466k in salary, and 133 in all other compensation, including severance payments, bringing the total to a whopping 1.2 million. Remember, this company isn't doing amazing, so the fact that they had to pay $1.2 million for a CEO that is no longer there might be of concern to investors. To compare it to other executives, Sandra Milligan, the former president, got around 358k. But it's worth noting that the agreement included working for a reduced salary, so the total compensation might have been even higher than this. Michael Buell came on in 2025, so his contract hasn't even started being accounted for yet, but already it's planned that he gets 400k. How will this stack against the compensation of previous executives? Can he turn the company around? The shareholders get to vote on the executive compensation, but here's the trick. The vote is advisory, which means it's non-binding, which means it means nothing. Well, not entirely nothing. The board intends to consider the results of this vote in making future decisions about executive pay. How much weight that consideration carries is anyone's guess. Here is the key table in the report. This is the pay versus performance where the SEC requires certain adjustments. Looking at 2024, the total summary compensation for the former CEO, Nicole Sanford, was 1.2 million, but the compensation actually paid as calculated by the SEC was around 834k. This is pretty high. The numbers don't really paint a pretty picture in the other years either. We've got some executive compensation figures that don't seem to match the overall performance of the company. TSR is total shareholder return and CAP is compensation actually paid. The returns from the shareholder decreased and the CAP increased. Next up is a proposal to approve issuing warrants, which are basically options to buy stock to certain related parties. They want to issue shares of common stock to related parties. The stock shares had to be placed below market value, and so the Nasdaq is requiring a shareholder approval before those can be delivered. Next is approval of an amendment to their stock incentive plan. They want to increase the number of shares they can grant by 2.5 million, bringing the total to over 4.5 million. As of the day that this proxy came out, they only had 730,601 available for grant. That may not seem like a lot for the company, which is why they need to add more to the pile. What's important about it is if they don't have it, it may make it difficult to operate. because the company would then have no shares available for future incentives. One thing the plan does not have is a liberal change in control definition. This is basically to stop executives from making it too easy for themselves to cash out if the company gets bought. Here it is, the moment you've been waiting for. They want approval to do a reverse stock split of their issued and outstanding shares. This is a move to boost the stock price by reducing the number of shares. Why do they want to do this? Because they need to keep their listing on the NASDAQ. To do that, they need to keep their stock price above $1. If they don't do this, NASDAQ could kick them off. So the board thinks this is the best way to keep things afloat, and they want the power to decide the exact ratio of the split somewhere between 1 for 10 and 1 for 60. It could make a big difference. However, reverse splits can also be risky and is not guaranteed. Quick peek, with stock options and warrants, the weighted exercise price $6. You are paying $6 for a stock worth a dime. It may be a problem getting to the point where the company would be a good place to be. The last section outlines the director responsibilities, the compensation, and any potential conflict of interest. It states that last year the executives didn't file all their reports. So what's the verdict? Aspira is facing some serious challenges and they're trying to pull all the levers they can to stay afloat. The reverse stock split is a gamble, and the high executive compensation in a struggling company is definitely raising eyebrows. The main problem here seems to be a revenue problem. They don't really seem to understand where they are going. While the steps they are taking here are required to remain listed on the NASDAQ and continue to operate, it remains to be seen if they will be able to turn the company around and justify the decision to have these board members in place. If they can't bring in the money, all the stock juggling in the world won't save them. Thanks for watching. If you found this breakdown helpful, give us a like, drop a comment, and subscribe for more corporate deep dives. Until next time, keep those investments smart and those expectations realistic.